Let me tell you something that took me years to truly understand. It changed the way I see trading. Most traders believe success comes from finding the right setup, the right pattern, the right indicator, or some hidden technique professionals won't share. But that isn't where success comes from. Success in trading comes from understanding your own mind, and more specifically, understanding how position size affects your ability to think clearly. I've worked with traders for decades. Brilliant ones, struggling ones, highly educated professionals who failed, average individuals who quietly succeeded, and one pattern kept repeating. The traders who survived weren't necessarily the smartest. They weren't running the most complex systems. They were the ones who understood the relationship between risk and psychological clarity. Let me explain. When you first start trading, you bring beliefs with you. Beliefs about success, about effort, about what it means to be competent. In most areas of life, bigger is better. More effort leads to more reward. Intelligence should pay off. Hard work should produce results. Those beliefs are deeply wired into us. So when we enter trading, we assume the same rules apply. A larger position feels like commitment, like confidence, like seriousness about money. A small position feels timid, safe, almost embarrassing. A big position feels powerful. Like this trade could change your account, maybe even your life. But the market doesn't care about your feelings. It doesn't reward effort. It doesn't respond to confidence. It moves according to probabilities. Your job isn't to prove anything. It isn't to make a statement. It's to execute an edge repeatedly without interference. And interference comes from emotion. Emotion comes from risk that is too large for your nervous system to handle. Now let's look at what actually happens. You put on a trade that's too big. At first, there's excitement, energy. This is the one, this matters. Then the market moves, maybe slightly against you, maybe in your favor, and then it pulls back. Something shifts, your breathing changes, your shoulders tighten. Your attention narrows. You start watching every tick. Every candle feels personal. This isn't analysis anymore. This is survival. Your brain has detected a threat, not physical but psychological. A threat to security, to identity, to being right. When the brain shifts into survival mode, rational processing weakens. Fear and urgency take over. Thoughts begin to form. I should have taken profit earlier. I can't afford this loss. Maybe I'll move the stop just a little. Maybe I should get out now. These thoughts feel logical, but they aren't logic. They are emotional reactions disguised as strategy, and the cause isn't your system. It's the size. Most traders misunderstand this. They think discipline is a character trait. That rule following is about willpower. It is. It's about whether your nervous system feels safe enough to allow you to follow rules. When you're calm, following rules is easy. When you're threatened, fear overrides logic. That's how survival wiring works. If you were being chased, you wouldn't calmly evaluate options. You would react. Oversized risk triggers that same reaction. A losing trade becomes a predator. A drawdown becomes danger. And once survival mode activates, your brain will protect you, even if protection destroys your account. This is why mistakes repeat, not because traders lack knowledge, but because they're operating in a state where their brain won't let them act rationally. Look at the common patterns. Hesitation. You see your setup, it's valid. But the position size makes the risk feel heavy, so you wait. You want more confirmation. You talk yourself out of it. Then it works without you. Now frustration builds. You promise you won't hesitate next time, but the next setup feels just as threatening. Or worse, you chase it late and get stopped out. The cycle continues. Then there's moving your stop. You placed it logically. It made sense at entry, but as price approaches, the loss feels unbearable. You move it. You call it conviction, but it's avoidance. Sometimes the trade reverses and you feel relief. Most times it doesn't, and a manageable loss becomes damage. Then there's cutting winners early. With oversized positions, profit feels fragile. You're afraid it will disappear, so you take it quickly. And then watch the trade continue without you. You think it's a targeting issue. It is. It's a size issue. And then the opposite. Holding losers too long, freezing, hoping, because closing the trade feels like admitting failure. Every one of these mistakes traces back to the same root. The position is too large for psychological neutrality. Your mind takes control away from your rules and hands it to fear. Now consider the opposite, a position size that feels almost too small. Small enough that your heart doesn't race, small enough that you don't obsess. When risk is small, something changes. The trade stops being personal. It's just one execution in a long series. You follow your plan because nothing inside you is fighting it. You let probabilities unfold. This is where clarity lies. Trading is a probabilistic game. Your edge is not about this trade. It's about what happens across hundreds. But for that to function, each trade cannot feel like a referendum on your identity. Small size makes that possible. You stop needing to be right. You stop trying to control the outcome. You execute. Consistency becomes available. You show up the same way each day. No drama, no emotional spikes, just process. And over time, avoiding catastrophic mistakes matters more than chasing dramatic wins. Now let's talk about ego, because this is where resistance lives. Trading small feels unimpressive. It feels like you're not trying hard enough, especially if you're competitive, driven, used to pushing yourself. Big size feels bold, small size feels weak, but that reaction is ego. Ego wants significance. It wants to prove competence. The market has no interest in your significance. It only reflects probabilities. There's another illusion here: control. If I risk more, I can make more. If I focus hard enough, I can make this work. But you don't control outcomes. You control execution. Ironically, the larger the position, the less control you actually have because emotion interferes. Small size doesn't surrender control. It restores it. Control over your responses, over your clarity, over your process. There's a truth many traders resist. The first goal isn't profit, it's survival. Survival means staying in the game long enough for probabilities to matter. It means not blowing up, not quitting from emotional exhaustion. Oversized risk prioritizes results. Small size prioritizes survival. And survival is what allows compounding to exist. Compounding isn't about dramatic returns. It's about sustained execution without self-destruction. When you trade too large, you interrupt that process. You have a good week. Then give it back in one emotional decision. When you trade small, you remove the emotional spikes that sabotage consistency. Your edge isn't about being right often. Even a strong system loses frequently. If losses feel threatening, you'll distort behavior to avoid them. If losses feel neutral, they become data, just part of the series. When losses stop meaning something about you, you stop interfering. And that's when the edge can function. The traders who last aren't the most dramatic. They aren't the ones with heroic stories. They're durable. Durability comes from emotional sustainability. Excitement is not strength. Excitement is intensity, and intensity destabilizes clarity. Calm looks boring. But calm is where consistent execution lives. Trading isn't about forcing outcomes. It's about removing interference, removing the internal resistance that distorts perception. When position size no longer triggers survival, something subtle happens. You see the market as it is, not as a threat, not as a judge, just movement. When resistance drops, there's a quiet neutrality. You place the trade. You let it unfold. If it loses, it loses. If it wins, it wins. There's no emotional spike attached. No identity wrapped around the result, just participation in probability. And in that state, nothing dramatic changes. There's no breakthrough moment, just steadiness. This is what trading looks like when fear isn't driving behavior. Not spectacular, not exciting, just clear. So here's something worth sitting with. When you increase your size, what actually changes? Is it your edge? Or is it your emotional state? And when you reduce your size, what becomes visible? Have you noticed how your thinking shifts depending on what's at risk? Have you seen what your mind does when the position feels too large? Have you seen what happens when it does? Have you noticed this in your own trading?